And now for something completely different. Dear students, I'm a big fan of Monty Python's Flying Circus, and some of you younger folks may or may not have come across their work from the 70s into the 80s. But they still get together every once in a while, although a couple of them are passed away by now. But they were involved in a lot of silliness, such as the Ministry of Silly Walks or cross-dressing lumberjacks in Canada singing their lungs out, or a poor woman being inundated with spam for breakfast. And whenever I think of technical analysis, I always like to think of Monty Python and silliness. So I'm probably the worst person to introduce you to technical analysis, in that I think it's just borscht, piffle, twaddle. But there are people who swear by it and will, tell you that I don't know what I'm talking about, and they'll teach you how to use technical analysis to become rich beyond your wildest dreams, and it'll only be $2,995 for a 5-day course, guaranteed. But when that doesn't work, we'll send you on the 2-week super secret $9,995 course that's in Hawaii. And if that doesn't, okay. Do, if you're so inclined, look up some of the research. It's not there. There's scant few documents that actually say that this stuff actually works on a predictable and long-term basis. But we got to learn about it, because you are the investment guru for your friends and family and coworkers, if only to explain to them that it's maybe a little bit better than reading chicken entrails or howling under the full moon as you dance around a bonfire, but not much better. I like to call it reading squiggles on a computer screen. So let's start with a quote. The fundamental analyst says you are buying companies, not stocks. The technical analyst says you are buying stocks, not companies. Interesting. What's going on here? Let's turn to slide 2 and review fundamental analysis. You are buying companies, not stocks. The in-depth study of the financial condition and operating results of a firm. A method of evaluating securities, in this case stocks, by attempting to measure the intrinsic value of the particular company, the stock that underlines the company. Fundamental analysts study everything from the overall economy and industry conditions to the financial condition and management of companies. Simply put, the value of a stock is influenced by the performance of the company that issued the stock. And to me, this just makes perfect sense, right? You're buying a business, as Warren Buffett likes to say. The valuation models from Chapter 4 and the ratio analysis that we did in Chapter 5 are examples of fundamental analysis. And to review, when we look at the fundamentals, when we look at the company, we want to know its competitive position of the company. Is it Coca-Cola or Pepsi-Cola or maybe Monster Cola? Its composition and growth in sales and earnings of what's going to happen in the future. Profit margins, the dynamics of the company, the company's earnings, the composition and liquidity of corporate resources, what assets are available, what's the company's capital structure, how much debt, how much equity. That's called the capitalization of the company. It just makes sense, right? I mean, you're investing in the business. Wouldn't it make sense to know everything you could about the business? But there are many investors who don't follow the fundamentals. They use, slide 4, what is called technical analysis, the study of the various forces at work in the marketplace and their effect on stock prices. Those who adhere to technical analysis believe that they can predict the future price of a stock by analyzing the behavior of the stock price's history and or the overall stock market. And they use one or many of dozens of so-called technical indicators. Simply put, the future price of a stock is influenced by factors other than the company's fundamental future outlook. Now, I'm sounding as if it's an either-or situation. For some people, it is. For me, for example, I don't do any technical analysis. I think it's voodoo. I think it's ridiculous. But other people, they live and die by it. They're usually short-term traders, not long-term investors. But then there are others who, they have a mix. They do some, fundamental analysis and some technical analysis. I think it's very telling that value line, which is mostly all fundamental analysis, has a technical indicator. Now, it's proprietary, which means they won't tell you how to figure it out. But I ignore it. I'm not interested in it at all. But others, you're going to decide. Slide number 5. What is the argument or arguments in favor of technical analysis? Well, stock prices do tend to move in tandem to the stock market as a whole. You hear the saying, when the market is rising, we hear the saying, a rising tide lifts all boats. When the market is rising, most stocks rise with it. Not all, but obviously the stock market is made up of many different stocks. So when the stock market is rising, most stocks are rising. Well, we saw, if you did the chapter 2, index funds and diversification and the S&P 500, the S&P 500 as a whole was rising very, very slowly if you took out those top 10 companies. So sometimes it's not true. So you hear the saying, a rising tide lifts all boats. And then when the market is falling, most stocks are brought down with it. And you'll hear the saying, when the tide goes out, you can see who's swimming naked. The rebuttal to that is, that's just how the system works. That's just supply and demand at work. When stocks are in favor, prices rise. When stocks are out of favor, prices fall. So repeat after me. There has never been a reliable methodology for predicting the short-term behavior of the stock market. For predicting the short-term behavior of the... folks, there are lots of methodologies out there that are unreliable in predicting the short-term behavior of the market. And if we go back to the 1990s, there was one company that was generally considered to have done it, called Long-Term Capital Management. And they were basically charmed existence. They had charmed existence. They had 2 Nobel laureates and John Meriwether, the best bond trader in the world that we gave his story back in chapter 1. And they looked like geniuses. They were given $6 billion of capital. And with that $6 billion, they controlled $100 billion of securities, of stocks, bonds. They did a lot with options, which we'll discuss later on and you should stay far away from. And they failed miserably, almost brought down the global economy. So here was a company that was supposed to have done it and turned out to have failed miserably. So there's no. If somebody says they're going to sell you their reliable short-term behavior, reliable method for predicting the short-term behavior of the stock market, tell them thank you very much. I'd rather buy the bridge you're selling. Slide number 6. Here are some of the tools. Market pricing, the momentum trading. The trend is your friend. Right, but beware the permanent trend. We're going to show you what are called support levels and resistance levels. These are support levels below which a stock or the market is unlikely to fall, and a resistance level is a price or level above which the stock as a whole is unlikely to rise until it breaks out, and then it's all history. Psychological barriers. People put credence in large numbers with lots of zeros in front of them. So 50,000 on the Dow, 6,000 on the S&P, 500, $100 for a stock. Oh, I can't get above $100. And then the very popular moving average. That's going to be your optional bonus assignment. And it's not hard to do, folks. It's pretty darn straightforward. And you don't even have to worry about doing it correctly because I don't know how to do it. And so all you have to do is convince me you know what you're doing, even though you don't know what you're doing. But don't worry, nobody knows what you're doing except for the people who say they know what they're doing so they can sell you their 5-day course for $2,995. And here are just some examples, folks. And there are dozens and thousands of these people out there wanting you to sign up for their $30 a month or $50 a month newsletters or whatever. You decide. I just think it's blah, 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 blah. I think it's blah, blah, blah. So you play with them and see what they say. In the face-to-face class, we would show one of these people doing their witchcraft, and I got some links on the website and Canvas. So you decide. And I'm going to show you a little bit of the witchcraft, although I'm going to be disparaging it. I'm not going to be telling you to use it. So here is the ever popular support and resistance lines. So supposedly here's Oracle back in 2002, bouncing up and down. And supposedly this was support line, but of course it bounced down to here. And then it gets up to this amount, and here's the resistance line, and then there's the support line, and there's the resistance line. And so, in other words, I think they're riffing on the idea that stocks tend to trade in a narrow range until there's some major breakout. Well, yeah, we know that, but does that mean we're going to be able to predict that? Well, I guess the idea is, hey, when it gets close to the resistance line, that's the time to sell. When it gets close to the support line, that's the time to buy. Again, it's recommending, it's encouraging short-term trading. I don't like it. Here's another example that here's the support line, here's the resistance line. So up to the resistance, down this doesn't look perfect. Oh, I could trade all day using that. And look, it's going to hit it, and then it broke out to the downside. That's the thing. You don't know when it's going to break out. So it's going to go up into the resistance level, down to the support level, up to the resistance level, down to the support level. It's going to do that forever and ever until, no, it's not going to do that until it's never and ever. Someday, whatever news is bad, whatever news is good, it's going to fall or rise. So you have to decide when the breakout is ready to come. This is the moving average. What's going on here? Well, this little purple guy here, violet, is the prices of the stock. This is one of the first, if not the first, and certainly it's very popular technical indicator. You go back 50 days and plot the 50-day moving average. Of course, the next day they have to go back 50 days and continue to do that. So notice that the brown here, I guess that's brown, is smoothing out the volatility of the day-to-day prices. And then you go back 200 days. So you have the 50-day versus the 200 days. Some people use the 15-day and the 50-day, or the 10-day and the 20-day. You decide which moving averages you're interested in. But the one that's talked about at least the most is the 50-day and the 200-day. So here, when the 50-day goes below the 200-day moving average, that's called the death cross. That's supposedly a very bad sign. When the 50-day goes above the 200-day, that's considered the golden cross. That's considered a great time to buy. Well, in this case, the price had already fallen, so it was kind of a little late, wasn't it? But in this case, hey, it actually worked, because if you had bought here, you had this huge run-up in the stock. But if you were to do an analysis of 1,000 or 200,000 situations where this happened, and then looked at what actually did happen, was it a good time to buy, was it a good time to sell? I think my understanding is it's going to basically say, you know what, it's not really very useful. At least that's what the scant research says. Maybe it might help, maybe not. So, and of course, it encourages short-term trading, which I'm doing my best to dissuade you from doing. And then people come back and say, well, Payano's using the 50-day and the 200-day. You really should use the 10-day and the 20-day, or the 15-day and the 50-day. Fine, good luck. The Dow theory. I wish somebody would explain this thing to me, because I can't understand it. This is one of the more historically popular price movement technical theories. It was created by none other than Charles Dow, the creator of the Dow Jones Industrial Average, co-founder of the Wall Street Journal. The problem is, before it was finished, Mr. Dow died. So he never got around to finishing it. So several people have given their ideas of what Mr. Dow actually was trying to do. And supposedly you're identifying three forces: the primary direction, the trend, the secondary reaction, that trend, and then the daily fluctuations. Yeah, I know. We know stocks go up and down. And by watching the changes in the primary and secondary directions, you are supposed to be able to determine the overall direction of the market. So here's, I'm sorry, what happened to my graph? It's coming up. The next two are the relative strength and the market volume. The relative strength is the measure of performance of one investment relative to another or to the market as a whole. Now, Value Line has this relative strength indicator. The Investor's Business Daily is very bullish on this, a big proponent of the relative strength. I'm more interested in how the company's going to do relative to itself and to its competitors. As the market as a whole, well, you have to decide. Do you want, having more growth-oriented, aggressive stocks, or are you more interested in boring stocks that probably won't beat the S&P 500 or the growth stocks, but will help you sleep better at night? So that's the relative strength. And then the market volume. People look at the market volume, and we're going to see that some of these graphs that we use have the market volume at the bottom of the graph. Supposedly, if you have heavy volume with prices rising, that's a good sign. Okay, great. But if it's low volume with prices falling, that's okay. Okay, it's okay. The price fell, okay, but it was low volume. Heavy volume with prices falling, well, it's supposed to be bad. Low volume with prices rising, well, that's not that good either. Again, where's the research? It ain't there, dear students. Go look for it. If you can find it, please let me know. So the breadth of the market, not the respiration breath, but how many stocks went up, how many stocks went down. Also called the advance decline ratio. When the mood of investors is bullish, the advanced decline ratio should rise. Advancing issues should outnumber declining issues. And actually, as a long-term indicator, no, but kind of, in that it can be useful in that what happened in the late 1990s is that the different companies were identified as either new economy, meaning internet and software and computer chips and computers themselves, telecommunications, and old economy, boring companies like real estate investment trusts and commodities, making not commodities in what we're going to talk about later on in futures, but what am I talking? Consumer goods like soap. And it turns out that a lot of the companies in the Standard & Poor's 500 were actually going down while the market was skyrocketing, while the companies in the new economy were skyrocketing higher. And so that was something of an indicator, and that's what's happened recently. If you go back a few years, most of the Standard & Poor's companies have done very little. It's like 2% that they've gone up. Whereas the NVIDIAs of the world and Microsofts and Apples and the FANGs we used to call them, now they call them the Magnificent Seven, have just skyrocketed. So, take that for what it is worth. The tick. This comes not from those bugs that suck your blood, but from the fact that before there was the internet, way before there was the internet, there was a ticker tape uh, 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 service that would tell you the prices of in stocks as they were being traded. And so they call it the tick. It's the trade by trade direction of the market. When the market's doing well, the tick is up. When the market's doing poorly, the tick is down. So what's the opening tick? What's the closing tick? Is it a bullish tick? Is it a bearish tick? Again, it would be something that might help you with short-term trading, but for long-term prudent investors, who cares? Now, this is something that actually is useful, if only to help you when there's a bear market or when the market falls precipitously. It's called the short interest. The number of stocks sold short in the market at any given time. Now, relax about the mechanism, because we're going to deal with that at the end of the semester. When investors, well, you're not usually investors, they're usually traders, speculators, are selling stocks short, they are trying to knock down the price of the stock or the market as a whole. And it's a very dangerous technique that hopefully you'll stay away from. I'm going to do my best to dissuade you from doing it. Peter Lynch, of all people, says don't short a stock. But for some reason, short investors are somehow considered more sophisticated and are therefore supposed to know when the market will fall. Do you remember the story, not Sir John Templeton, oh my goodness, the Keynes, Sir Mike Keynes, John Maynard Keynes, when he was asked, Mr. Keynes, how can the market be so irrational? These were people who were betting that the market was going to fall. And he said the market can stay irrational longer than you can stay solvent. And the problem is, if the market goes up or the stocks that you short go up, you lose a lot of money very quickly. It is very dangerous. So when the large number of investors sell short, what happens? They got to buy it back. When you buy a stock to go up, you can keep it forever. But when you sell a stock short, you got to buy that darn thing back, unless the company goes bankrupt, and then you don't care. So this creates a pent-up demand for stock. When there's a large number of short selling, it's like a compressed spring. You're pushing down on this spring, and eventually it's called a short squeeze. These people have to buy those shares back. So when the market falls, 4 or 5% within a couple of days, people go, what do I do? What do I do? I say, relax. Just wait a few days. And then all of a sudden, bingo, it jumps back up again. And they say, how did you know that was going to happen? I said, well, I didn't. I was just guessing. But much of that we can assume, we don't know. We're not going to interview everybody who did it. But we can assume much of that downturn was because of short sellers who were pushing down the shares, the price of the shares. And then when people start buying and the price goes back up again, it's called covering their positions. They've got to turn around and buy back the shares, and bingo, that creates that pop, that short squeeze, as it's called. And if you followed the GameStop a few years ago in AMC, where there were a lot of sophisticated investors, supposedly hedge fund managers, who were knocking down the price of GameStop, and a bunch of people, millions on Reddit, got together and said, "We're gonna mess with those people. We're gonna raise the price." And all they had to do was start buying, and of course the price rose. And these hedge fund managers just got right when the tide goes out, you can see who's swimming naked. They were swimming naked, and that skyrocketed the price of the shares, and then they fell. It's speculation. Be careful, folks. But this gave me a lot of what's the word? Made me feel good in August of 2002. It gave me a little bit of feeling like, okay, we're getting near the end. It was really bad, folks. It was like water torture. The stock market had gone in two directions in the 80s and 90s, up and way up. And then 2000, 2001, and 2002, the market just kept falling and falling and falling like water torture. It wasn't like 2008, which was like a bolt of lightning out of the sky. But in August of 2002, there were more shares sold short than ever before in the history of the market. And I thought, okay, we're getting near the end. And of course, hindsight, the end was October of 2002, although it popped back down in March of 2003 a little bit, but the bottom was 2002. So when you see that, it's a contrarian indicator. Okay, how are we doing for time? I'm going too slowly. I apologize. Hope I'm not boring you. Speaking of contrarian opinion is the theory that if people are very optimistic, that is a predictor of falling prices. And if people are very pessimistic, that is a predictor of rising prices. Well, we've already discussed that. When you hear people say, ooh, is it too late to get in? The answer usually is, yeah, it's too late to get in. And when you hear people say, oh, is it too late to get out? Yeah, it's too late to get out. Now's the time to be buying. So, to make this work, we should all walk around going, oh man, the market's going to fall. Oh man, the market's going to fall. And I use this a little bit myself. I read, I'm constantly reading about what's going on, looking at various websites. And the New York Times used to have a really good section, and they pared it down. It's still pretty good, but when you start seeing lots of articles about how great it's going to be, and maybe you should buy this stock, it's going to explode, and this is going to be great. Dow's going to go up, and this S&P. That's when I figure, okay, we're down. We're going to go down. And then when you see articles about, oh, terrible, you get your money out right now, then you realize the market's. This is what's happened for decades. So we covered contrarian strategy already. You buy when others are selling. You sell when others are buying. The problem is, as I forget his name, Leonard Kaplan, was it? It's not a steady business, right? The market has historically gone up 3 more times more often than it goes down. So you have to wait. You have to sit on your hands until there's blood in the streets, and then you swoosh in and buy, and then you wait till people are euphoric, and then you sell. But for us little people who are just accumulating our nest eggs, it's not something I would normally be involved with. I must admit, I'm not trying to blow my own horn, but I did act as a contrarian in real estate. When I first met my wife, she was terrified of stocks, and I would have to explain to her that for the long term they're not so bad, and it took me a while. She would always want to buy real estate, and I would say, well, Nita, because that's her name, it's too darn expensive. If I'm going to buy real estate, I want the rent as an investment. I want the rent to cover the mortgage and the insurance and the taxes and the maintenance, and I want it to be cash flow positive. Well, for decades, that's not what happened in San Diego. You were cash flow negative. Now, the capital gains, did you very well, typically, unless you bought in 1990 and sold in 1992, or bought in 2005 and sold and went through foreclosure in 2008. But in 2008, 9, and 10, prices fell so low that I went to my wife and said, hey, let's look at some real estate. And then she said, you got me feeling okay about stocks. It turned out okay. But with regard to stock investing, I've done a little bit of contrarian, not much. I can't really say. In 2008, I thought the market was going to fall about 25%. My buddy, who's much more aggressive than I am, said 50%. He was right. When it went down in October about 20-some percent, I bought. I put a chunk of change in, and then it went down another 20%. So it's not easy. Odd lot trading. We really should get rid of this slide because, first of all, odd lot trading is commonplace now because of technology. But this is based on the theory that small investors tend to buy and sell in odd lots. Remember that odd lot is less than 100 shares. The best thing to do is the opposite of what small investors are doing. So if odd lot trading rises, supposedly means that more and more small investors are entering the market, and small investors are supposedly notorious for getting into the market at the top and getting out at the bottom. The theory, the research, very suspect. Plus, as we said, who cares about odd lot trading anymore? You want buy 7 shares, buy 7 shares. However, you're still going to hear the pundits, oh yes, small investors are buying, so it's time to sell, or small investors are selling, so it's time to buy. I don't know about you, but I've seen some large investors, institutional investors, making really stupid, really stupid, boneheaded maneuvers. And so I don't think it really matters whether you're a small investor or a large investor. Everybody is an animal, a human, that is ruled often by our emotions. Slide 16. Ah, finally, we get to the charting. The activity of charting price behavior and other market information, then using the patterns these charts form to make investment decisions. There's open, high, low, close charts and candlestick charts, resistance and support level charts, breakout, we saw that, the head and shoulders, the dreaded head and shoulders, the triangles and wedges, the flags and the pennants, the cups and the handles. I hear that reading tea leaves while howling at the full moon works great, and I think it's about as good, maybe not quite as good, but a lot more fun than reading squiggles on a computer screen. But this is what people are going to try to sell you. They're going to try to sell you that they can do it and they can teach you to do it, and all you got to do is hand over $5,000. Oh, but today for you, $4,000. Here's the candlestick, and if the this is the low for the day, this is the high for the day, right? And then here's where it opened, and if it closed higher, the candlestick will be green. If it closed lower, it'll be red or black or whatever. So if the close is higher than the open, that's supposed to be a bullish candlestick, right? Because it went up for the day. If the close is lower, that's supposed to be a bearish candlestick. Well, we know that prices go up and down. So in the chart at left, first, the candlesticks are telling us that the stock price went up, and then the stock price went down, and then the stock price went back up again. Very insightful analysis. Yeah, people ask me, what do you think the market's going to do? I say, it's going to go up and down. And they go, well, I knew that. I said, well, why'd you ask me? Actually, the first person who is very well quoted, J.P. Morgan, John Pierpont Morgan, J.P. Morgan, Chase Bank. Somebody supposedly asked him, Mr. Morgan, what's the market going to do? And Mr. Morgan said, the market will fluctuate. Yeah, we knew that already, didn't we? Yeah. Here are some candlestick formations, and these are bad. The dark cloud covering, the bearish engulfing pattern, and harami, which I think either it means Japanese for pregnant or it's Hindi for thief, whatever. At least this is what I read on the internet, so it must be true, right? Short-term trading. It obviously is for short-term traders because we're looking at a stock 3, 4, 5 years from now, not 3 days from now. And here is the dreaded head and shoulders. Now, I took the Series 7 back in 1998, before many of you were born. And this was the only question about technical analysis. And all they asked was, could I identify the head and shoulders? So here's the head, here's the left shoulder, here's the right shoulder. And this is supposed to be bad, right? But they didn't ask if it was bad or good. All they asked is, could I identify the head and shoulders chart? And so if this happens, that's supposedly a bad sign. I don't know. I don't believe it, but it doesn't matter. Just, can you identify the head and shoulders? And this one is promoted by that newspaper, Investors Business Daily, which is out of LA. It was supposed to be a big competitor to the Wall Street Journal. Really never made the big time. But we got it at the brokerage firm I worked at originally. And I thought it was okay. Had some pretty good articles. But the guy who developed it, who founded the newspaper, was a big technical analysis fan. And he created this cup and handles. And here's the idea behind it. It's supposed to be a bullish indicator. The stock fell precipitously, and so these people who bought up here, they're not happy. They're waiting for the stock to go back up to where they bought, and then they're going to sell. So there's the cup, and then it comes back up again, and then they sell. So there's the handle of the cup, and now those people are gone. Now new people are going to come in. I mean, you have to decide whether you believe this or not. I don't believe it. It doesn't matter to me. I'm not going to go out and interview all the people who bought and sold, and so I don't know. But take it what it's will. You're going to take it for what you believe it's worth. You're going to see people talk about it. You're going to hear them decide whether they want to make any investment decisions, trading decisions, based on the cup and handle. And then there's flags and pennants. And I'm not really sure. The flag is good and the pennant is bad? Or is it the pennant is good and the flag is bad? You have to decide. And then the simple moving average with Bollinger Bands. Now, I'm not exactly sure what Bollinger Bands are supposed to do, but I think when the price gets, here's the Bollinger Band, here's the price, the green, and this is the one Bollinger Band in blue at the top and the other Bollinger Band. And supposedly when the price gets close to the bottom, that's a good time to buy, and when the price gets close to the top of the Bollinger Band, it's a good time to sell. Again, it's trying to get people to trade short term, and we wish them a lot of luck because they is gonna need it. Now here, this is from the technical analysis, I guess, reached its mania in the 1970s, but it's still been around since then. And this is from A Random Walk Down Wall Street. Somebody actually wrote this or said this to their clients or whatever. You too, folks, can be a technical analyst. All you got to do is talk gibberish and people will believe you. The market's rise after a period of reaccumulation is a bullish sign, but nevertheless, fulcrum characteristics are not yet clearly present, and a resistance area exists 40 points higher in the Dow. So it is clearly premature to say that the next leg of the bull market is up. If, in the coming weeks, a test of the lows holds and the market breaks out of its flag, a further rise would be indicated. Should the lows be violated, a continuation of the intermediate term downward trend is called for. In view of the current situation, it is a distinct possibility that traders will sit in the wings, awaiting a clearer delineation of the trend, and the market will move in a narrow trading range. What did he say? I think he said, if the market does not go up or down, it will remain unchanged. I think that means, is that what you got out of it? The market will fluctuate. And now, I want to get paid $500,000 a year plus bonuses to be able to tell people this goopity goop and tell them to sell. Buy, no, hold. Yeah, right. Yeah. I told you at the beginning, right? I'm not the best person to be introducing you to technical analysis. Go look it up. Actually, Wikipedia has a pretty good article on it, trying to do the pros and cons, and Vistapedia also, and then all the other places that are trying to sell you training to become a technical analyst. So, one last time before we end our long march on stocks, I'm going to remind you that the industry needs more people, folks. They're always looking for new professionals. We need more women, bilingual, minorities. They love veterans. They absolutely adore veterans. So the place you usually start is with a registered representative, which is the legal term for a stockbroker, financial representative. Now many people are starting as a registered representative and then they're getting their registered investment advisor. You see, I never say I'm a financial advisor. You're not supposed to say that. I'm a representative. To be a financial advisor, you have to have one of these designations. Like it's basically the same thing, folks. They're going to do a background check. You can't have shenanigans with other people's money, right? You're dealing with other people's money. You can't be a flake. There are two exams that you typically start off with, the Series 7 and the Series 63. Series 63 is pretty straightforward. It takes about 2 weeks of studying. It's only an hour. I forget how many questions. Not many. It's not hard. Series 7 is a bear. It takes about 2 to 3 months of studying 1 to 2 hours a day. At least that's what I did. I had a student who studied nonstop, like 8 hours a day for 2 weeks, took it and passed it. It's 3 hours in the morning, and then you get an hour for lunch, and then 3 hours in the afternoon. It's a grueling exam. And they tell you right off the bat, it's going to start off pretty easy, and then it's going to get harder, and there's going to be questions that you aren't even going to be able to answer. Don't worry, we don't count those. Now, why would they do that? Just to make you feel horrible? I mean, there were some questions I looked at and I was like, where did that come from? What did that have to do with anything that we're studying? But the cool part is that what you're learning in this class makes up quite a bit of what's on the exam. Now, there's going to be a lot more stuff about compliance, and we don't really spend a whole lot of time on initial public offerings. You got to learn that inside out. But the two parts that really trip people up are the options, and we're going to see those later on, and the buying on margin shorting, the margin accounts. Those really trip people up because they're like mirrors. If you zig when you should have zagged or vice versa, you're going to get the wrong answer. So if you're so inclined, contact me. Here was the rub. For decades, you had to be sponsored by a brokerage firm. And many brokerage firms were reticent to hire someone until they knew that they could pass the Series 7. It didn't matter, how you got a 4-year degree. Like, you can't pass that Series 7, you don't have a future with us. So for this reason, FINRA, the Financial Industry Regulatory Authority, now offers the SIE, Securities Industries Essential. It's basically a baby Series 7. And it's not as grueling, and you don't have to be sponsored. It doesn't cost several $100s. I think it's like $80, something like that. And you don't have to be sponsored. So this one is relatively straightforward. Much of the material you're learning in this class is on there. And they give you practice exams, and there are things you can check out at the library or software packages. Plenty of places want to sell you stuff. But you take the practice exam on FINRA's website. That'll really show you what you're up against. If you pass that, the industry will come a-calling. They will start sending you solicitations. Hey, come work for us, because then they know you're going to pass the Series 7. And you don't have to work in the brokerage firms. There's mortgage brokering, there's insurance, there's banks and credit unions. There's the industry is immense, folks, and we hope you'll consider it. Because with a 2-year degree or less, you can get your foot in the door and start making money. And we guarantee you won't leave Southwestern with $120,000 worth of student loan debt, which you would if you went to the University of Spoiled Children. I'm sorry, University of Southern California. And here's the dirty little secret, folks. When it comes to dealing with the public, the technical know-how, obviously you have to understand the products, you have to understand the stocks and bonds and all the stuff that we're discussing, and there's a lot of material, but as hopefully you've noticed, it's really not that hard. It's the intellectual part of investing is pretty straightforward. It's the emotional part that drives people nuts. But it's the soft skills, as we call them, the soft skills. Can you deal with people? You're not a flake? Do you answer your phone calls? Do you call your people back? Do you engender trust with people? Because a lot of it is just trust. Because there's an awful lot of, I shouldn't say an awful lot, but you run into people in our business who really do not put the best interests of the clients first. And to me, it's just inexcusable. But you see it a lot. You see a lot of people like that, and they've convinced themselves that they're honest and doing what's best for the client. But first, they're doing what's best for themselves first. Cool. So, of course, I can talk about this far longer than any reasonable person would ever want to listen. But if you have any questions about what it's like to work in the industry, please contact me. Please, 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 please. We need you. Slide number 24. Oh, we're finished with stocks. Go back to chapter 3, start all over again, folks. Repetition is the key to learning. You cannot know this material too much. You cannot have gone through this material too often. And of course, we hope that you will get lost in a nice way when you do your research of different companies and different mutual funds, and because we're ready to start bonds. Boring bonds, stodgy bonds, reliable bonds. Thank you so much for being in our class, dear students. We are so, so proud of you.